Welcome back. Let's jump right into today's explainer because we are tackling a massive, high stakes issue in the energy transition space. We're looking at the often hidden world of battery raw material sourcing for utility scale assets. Specifically, we're diving into the transparency dilemma in battery supply chains. You know, that relentless tug of war between upfront cost and long term bankability. If you're anywhere near asset management, engineering, or procurement, this is going to completely change how you view your supply chain metrics. To set the stage here, let me throw a direct question right at you. EPCs and procurement leads, how do you balance aggressive initial cost targets against the long-term bankability and degradation risks of Tier 2 material suppliers? It is so tempting to hit those aggressive targets by going with cheaper, maybe less proven suppliers, right? But how exactly do asset managers balance those immediate wins against the looming long-term degradation risks? Okay, let's dive right into this. Section 1, the false economy trap, chasing cheap materials. So this false economy isn't just about making general budget cuts. It happens specifically when you chase short-term cost reductions, like grabbing cheaper graphite or maybe alternative cathode precursors. Now, on day one, saving a fraction of a percent on your upfront capex makes the project look brilliant. You came in under budget, everyone's happy. But that short-term chasing is actually setting a dangerous trap. It ultimately creates a massive financial risk, mainly because those fractional savings completely blind decision makers to the actual quality of what's going inside those battery cells.
Which brings us to Section 2, hidden degradation and anomalies, the cost of opaqueness.
Because when we move off the spreadsheet and into the actual field, the reality of these opaque supply chains hits really hard. Look, in the initial procurement phase, everybody celebrates those favorable upfront metrics and capex savings. But then we hit utility scale reality. When those batteries are deployed and expected to perform under immense stress, you aren't just getting a slight dip in performance. You get unexpected capacity fade. And worst of all, thermal anomalies, which, let's be honest, is just a very polite engineering way of saying your multi-million-dollar investment is literally on fire.
And this brilliantly illustrates the exact domino effect leading to those catastrophic losses. Think about it like a chain reaction. You source cheaper graphite and precursors through opaque supply chains, which directly introduces hidden material inconsistencies. The material just isn't uniform. Then, once the battery starts cycling, those inconsistencies trigger accelerated degradation. Your battery holds less charge much earlier in its lifespan than anyone projected. And at the very end of that chain, the ultimate disaster for utility-scale asset, unexpected capacity fade, and thermal events in the field that completely wipe out your ROI and pose massive safety risks.
So how do we fix it? That's Section 3, transparency as a financial shield, protecting BES bankability. To really reframe this conversation, we have to embrace one core philosophy. True supply chain transparency isn't just a compliance exercise. It's a core financial shield. Too often, we see asset managers treating transparency like it's just a box to tick for regulators or some environmental audit, like a necessary chore. But in reality, it is a strict, bottom-line financial anchor. Knowing exactly what goes into your batteries is what actually protects your project's bankability and shields your asset from the catastrophic losses we just looked at. All right, moving to Section 4, 3 due diligence strategies for EPCs. So the crucial point is, knowing that transparency is your financial shield, how do you actually deploy this in the real world? Well, here is a very specific 3-step due diligence playbook. Step 1, outright reject opaque supply chains and mandate transparency right from the start. Seriously, if a supplier hides their homework, you walk away. Step 2, actively audit the materials to prevent those inconsistencies that lead to accelerated degradation. Don't just take their word for it, verify it. And step 3, thoroughly vet those Tier 2 material suppliers specifically against long-term degradation risks, not just price and delivery time. Vetting their historical data on capacity fade is absolutely your best defense mechanism against falling into that false economy trap. As we wrap up this explainer, I want to leave you with a final, provocative thought to take back to your teams. Are your fraction of a percent CapEx savings today paving the way for catastrophic capacity fade and thermal anomalies tomorrow? Because in utility-scale storage, you know as well as I do, you always pay the piper eventually. It's incredibly important we rethink how we measure procurement success. If you're an asset manager in EPC, I really hope this leaves you eager to apply these 3 due diligence strategies to your next BSS project so you can ensure your investments are truly bankable for the long haul. Thanks so much for joining me today, and keep learning.